Welcome to Iron Financial. This is the show where we forge stronger portfolios by putting companies to the test and cutting right through the market weakness. I'm your lead analyst. Today, we're taking National Beverage Corp. You know them by the ticker, FIZZ. And we are putting it on the rack. We're not just going to look at some charts and call it a day. No, we are conducting a full-blown structural analysis. We are going to apply immense pressure, we're going to simulate real market stress, and we are going to find out if this company is built on a foundation of solid steel or if it's really just built on sand. We need to know, is this a solid as a rock investment, or are we about to discover critical stress fractures? To help me apply that pressure, I've got our market skeptic in the room.
Right, and let's just get one thing straight right out of the gate. Everybody hears National Beverage and their brain immediately goes to one place, LaCroix, the sparkling water. It's the one that gets all the press, the one that blew up on social media, the brand that basically defined a whole category for a while. But here's the deal. That's just the shiny facade. That's the part of the structure they want you to see. The company we're actually digging into today is built on a way more diverse, you might even say strange, portfolio of brands. You've got these absolute legacy brands, these carbonated soft drinks like Shasta and Faygo. I mean, these have been around for more than a century. They have this deep, almost cult-like regional loyalty that you just can't buy. Then, on the other end of the spectrum, you have their energy drink, Rip It, which is this quiet challenger that has a shockingly strong foothold, especially within the US military. So this isn't a one-trick pony. We're talking about a collection of very different assets, each with its own little moat.
And that, right there, is the multi-billion-dollar question, isn't it? It's one thing to have a scrapbook of famous old brands, but it is a completely different challenge to weld them together into a single, cohesive structure that can actually withstand the brutal, non-stop pressure of the beverage industry today. I mean, let's be real. We are talking about a market that is absolutely dominated by titans, the cola giants, companies with effectively unlimited cash for marketing, for distribution, for starting price wars that are designed to do one thing: bleed out smaller competitors until they're gone. So the question we have to answer is, can this quirky portfolio of niche and legacy brands really hold its ground? Can it actually bear the load when the giants decide to throw their full weight around just to get another inch of shelf space? That's what we are here to figure out.
Okay, let's get into the blueprint for today's analysis. Here's how we're going to break this company down. First, we're going to examine the foundation. We need to understand what this company actually is and how it claims to compete. Then we get to the heavy lifting, the financial stress test. This is where we put their numbers under the microscope and apply some serious pressure. After that, our skeptic here is going to take the lead in searching for cracks. We're going to look at the bear case, every potential weakness, every vulnerability. From there, we'll shift and assess management's reinforcements. What are they actually doing to shore up the defenses? And finally, we'll put it all on the scale and deliver the final verdict from Iron Financial. Let's get to it.
All right, first up, the foundation. Look, before we can stress test any structure, we have to understand its original blueprint. What is the core strategy here? How does National Beverage position itself in this absolute shark tank of an industry against competitors that have 10, 20, even 50 times their marketing budget? We have to get inside their corporate identity before we can even begin to judge their performance. This is the bedrock of our entire analysis today. Everything builds on this.
Exactly. And it's fascinating, if you actually pull up their 10K, their big annual filing with the SEC, they paint a very, very specific picture of who they are. They don't even try to pretend they're one of the giants. Instead, they frame themselves as the clever, fast-moving underdog. They love to use phrases like innovation ethic and speed to market. Their entire playbook is built on this idea that they can spot a consumer trend, like this healthy transformation away from sugary sodas, and then react way faster than their giant competitors, who they say are, I'm quoting here, burdened by legacy production and distribution complexity. So you see, their primary weapons aren't billion-dollar Super Bowl ads or plastering their logo on every stadium. It's supposed to be innovation, unique flavors, and creative packaging that just pops on the shelf. The question is, are those weapons really powerful enough for the war they're in?
And that question brings us right to the heart of what we do here at Iron Financial. It is time for the financial stress test. A company's story, their marketing pitch, that's one thing. Their numbers, that's the truth. And the numbers, well, they don't lie. We are about to put their financial statements under intense scrutiny. We're going to apply pressure to the revenue, to the margins, to the balance sheet, and we're going to see exactly where and if this structure starts to buckle. This is where we separate the corporate buzzwords from the cold, hard reality of the business. So let's start at the very top of the income statement. Let's talk about net sales. According to their fiscal 2025 10K, which just closed out, their sales hit $1.2 billion. Now that is a 0.8% increase over the year before. And look, on the surface, that seems
Fine, it's not setting the world on fire, it's not explosive growth, but it's positive. It suggests a mature company that's kind of holding its own, grinding out a small win in a market that's just a street fight. It looks solid, stable even. But that's just the headline number.
Whoa, hold on a second. That's the number they want you to see, but the fine print, the little clause right after it, tells a profoundly different story. And this, right here, is exactly why you have to read every single line of these filings. I'm pulling this quote directly from that exact same report. While their sales, measured in dollars, went up a little bit, the actual amount of product they sold, the case volume, went down. It fell by nearly a full percentage point. Let that sink in for a second. They are selling less liquid. Fewer cans are leaving the warehouse. Fewer bottles are going into shopping carts. So that 0.8% sales growth, it's not coming from more people buying their drinks. It's not from gaining an inch of market share. It's coming from something else entirely.
And there it is. That's the fundamental tension in this entire stock story right now. What are we actually looking at? Is this a sign of incredible brand strength? That their customers are so loyal they can just jack up the prices and nobody leaves? Is that incredible pricing power? Or is this a massive flashing red flag? A signal that core demand is actually getting weaker, that people are walking away from the product and management is just cranking up prices on the few loyalists who are left to keep that top line from going negative? Is this a strategic move? Or is it a short-term fix that's just papering over some very serious cracks in the foundation of the brand? This one data point is a fork in the road, and the two paths lead to completely different conclusions.
It's a fair and absolutely critical question. But before we declare a structural failure, let's look one level deeper. This is where it gets really interesting. Take a look at this trend in their gross margin. Even while they are selling fewer cases, they are becoming significantly more profitable on every single case they do so. The margin has been climbing steadily. It went from 36% to 37% last year, and in their most recent quarter, the first quarter of fiscal 2026, it hit a really impressive 38%. Now, the company says this is because of two things: those higher prices we just talked about, and, crucially, lower costs for things like aluminum cans and packaging. So while that volume number is a huge concern, from a pure operational standpoint, the structure is getting more efficient. It's getting stronger, not weaker. They are squeezing more profit out of every single can that goes out the door. Okay, profitability is one crucial load-bearing wall in any company. But the real test, the ultimate test of a structure's ability to withstand a Category 5 hurricane is its balance sheet. A company can have fantastic margins, but if it's drowning in debt, one bad quarter, one aggressive move by a competitor, and the whole thing can come crashing down. So we need to inspect this balance sheet piece by piece and determine if this thing is a fortress, able to weather any economic storm, or if it's just a house of cards waiting for the wind to blow.
This, right here, is the first pillar of that fortress. As of their latest quarterly report, National Beverage is sitting on $250 million in cash and cash equivalents. Now, this is not just a number on a spreadsheet. This is financial armor. This is dry powder. It is a war chest. This gives them an unbelievable amount of flexibility. It means they can decide to fund a huge marketing push, they can survive a prolonged price war with Pepsi, they can launch an entire new product line, or they can buy back their own stock, all without having to go hat in hand begging the banks for a loan. This is a massive, massive cushion against uncertainty.
And this slide right here is the second, and you could argue even more important pillar of that fortress. Zero. That's not a typo. That is the amount of money they have borrowed against their $150 million line of credit. They have zero long-term debt on their books. None. In an environment where corporations are leveraged up to their eyeballs and getting crushed by rising interest rates, National Beverage has a completely clean slate. This is a monumental point of strength. It means they don't answer to creditors. There are no debt covenants choking their decisions. They aren't burning through millions of dollars every single quarter just to pay interest. Every single dollar of profit they make can go right back into the business or into shareholders' pockets. This is the very definition of a rock-solid financial foundation.
A fortress balance sheet is great. I will give you that. Zero debt is impressive in any decade. But here's the thing. A fortress sitting in a peaceful field is one thing. A fortress that is under constant 24/7 siege is something else entirely. It's time to flip the script. I'm taking the lead now, and we're going to go actively searching for the cracks, because I promise you, every structure has a weak point. Every fortress has a vulnerability. We're going to probe for every single one of them and see what the bear case really looks like when you stare it right in the face.
And make no mistake, the siege is already happening. Let's just call it the sparkling water wars. Look,
LaCroix might have been the king of the castle for a while there, but the competition they face now is just relentless, and it's coming from every conceivable direction. In their own 10K, they admit it. They say they're up against companies with, and I quote, substantially greater financial, marketing, and distribution resources. We're talking about PepsiCo dropping millions on its bubbly brand. We're talking about Coca-Cola taking Topo Chico from a cult favorite to a mainstream monster. And it's not just the two giants. You have these ultra-trendy upstarts like Liquid Death that are capturing a whole new generation with brilliant, edgy marketing. And then, creeping up from below, you have the silent killer. Private label, store-brand sparkling water from every single major grocery chain, offering basically the same thing for a lower price. This isn't a simple battle. It is a multi-front war for every single inch of shelf space. And this war is having a direct and, frankly, brutal impact. Let's go back to that volume problem, but let's use the absolute latest data from Q1 of fiscal 2026. The negative trend isn't just continuing, it looks like it's getting worse. In that first quarter, the average selling price went up by a pretty hefty 4.4%, but the case volume, it dropped by 3.9%. You see the pattern? They're pushing prices harder and harder, and they're losing volume faster and faster. This looks less and less like some brilliant strategic use of pricing power and more like a desperate attempt to keep their head above water. How long can you keep raising prices while your actual customer base is shrinking before you hit a brick wall? At some point, even the most loyal fans will trade down to the store brand or try that new thing from Coke. This is not a sustainable path to long-term growth. It just isn't.
And hey, don't just take my word for it. It seems we're not the only ones seeing these cracks start to form. Let's take a look at what these so-called experts on Wall Street think. This is analyst sentiment data from MarketBeat. Now, first off, there's very little coverage of the stock, which is a bit of a red flag all by itself. But of the analysts that do cover it, well, the sentiment is unanimous. And it's ugly. 2 analysts have a sell rating on the stock, 0 have a hold, and 0 have a buy. When the people whose entire job is to analyze these companies are all standing at the back of the room and pointing to the exit sign, you have to take that seriously. That is a massive vote of no confidence from the professional investment world.
And their negative feelings aren't just talk. They're backing it up with actual price targets. The consensus target price from these analysts is $35 a share. Now, with the stock recently trading well above that, what Wall Street is telling you, explicitly, is that they believe this stock is overvalued and has significant downside from its current price. They're telling their biggest clients in no uncertain terms that they expect the share price to fall from here. This just puts a big exclamation point on the entire bear story. We have declining volumes, crushing competition, and a stock price that the pros believe simply does not reflect the massive risks to the business.
The bear case is strong. There's no way to deny that pressure. That volume decline is a serious issue, and you can't just brush it aside. But a well-built structure under stress doesn't just sit there and wait to collapse. A smart team, a prepared team, shores up the defenses. They add reinforcements. So now let's look at what management is actively doing to fight back. This is not a company that's just sitting on its hands. Let's examine the bull case and the specific, strategic moves they are making to defend their turf and to try and prove all those bears wrong.
Management's main counterattack is their oldest weapon, innovation. This has always been their core strategy. The entire bet is that they can outmaneuver the slow-moving giants with a constant stream of new and exciting flavors that create buzz and get people talking. They've seen some real success with this recently, pointing to their deliciously magical variety pack, especially in the big high-volume club stores. And they're not stopping there. They've already announced their next big launch for early 2026, a brand new pineapple coconut flavor. The strategy is crystal clear. Use novelty to keep your existing customers engaged, to generate free media, and to give shoppers a clear reason to pick up a case of LaCroix instead of one of the 10 other options next to it. It's a fundamental bet that flavor and creativity can still win against a billion-dollar marketing budget.
And it's not just about dreaming up new flavors. They are making other concrete, strategic moves to reinforce the entire business. As I mentioned, they are specifically targeting and seeing real organic sales growth for LaCroix in the club channel. That's a critical retail battleground. They've also fired up a share buyback program. Now, this is a classic corporate move, but it's important. It returns cash to shareholders and, more importantly, it's a powerful signal. Management is using the company's own cash to buy its own stock. And to make sure you get the message, they've come out and publicly stated that they believe current trading prices, and I quote, do not accurately reflect the underlying value of the company. That is a direct public statement of confidence from the people who know this business better than anyone else on the planet.
All right. We have laid it all out on the table. We have examined the foundation. We have run the financial stress tests. We've gone looking for every single crack. And we have analyzed management's reinforcements. The bull case and the bear case are both clear and they are both compelling. So that brings us to this, the final critical moment, the verdict. It's time to weigh all of the evidence, to measure the obvious structural strengths against the very visible cracks, and to determine if National Beverage is a deeply undervalued opportunity for investors or if it's a very dangerous trap.
So let's put it all on the table for one final showdown. The bull case, my case, rests on that absolutely unimpeachable fortress of a balance sheet. Zero debt, $250 million in cash. That gives them a level of resilience and flexibility that 99% of companies can only dream of. You add to that the rising gross margins, which prove they can still grow profitability even with these headwinds, and you have a management team that's so confident they're buying their own stock. But the bear case is just as powerful. That decline in case volume is the flashing red light on the dashboard that you simply cannot ignore. The competition from the cola giants is not a temporary problem. It is the new reality, and it's only going to get worse. And then you have Wall Street, for what it's worth, screaming from the rooftops to sell. It's a classic Wall Street battle between a pristine financial structure and a rapidly deteriorating business environment.
So here it is, the final verdict from Iron Financial. Is this company going to go bankrupt tomorrow? Is it going to collapse? Absolutely not. The structure is sound. That balance sheet is a fortress of steel and reinforced concrete, and it has been meticulously maintained. They are in zero danger of any kind of imminent financial distress. However, and this is the most important part of our entire analysis, the ground underneath that fortress is unstable. The foundation is settling. That persistent and seemingly accelerating decline in case volume is a serious seismic issue. It suggests that consumer demand, the very earth on which this entire company is built, is shifting right under its feet. And while the structure itself is more than strong enough to withstand these tremors for now, a settling foundation can, over time, cause critical fractures in even the strongest walls. So this isn't a simple buy or a simple sell. It's a situation that demands extreme caution. The structure is holding, but the real question you have to ask yourself is, for how much longer?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.